Good morning. If you've filled up your car or checked the news lately, you've probably noticed oil prices are on the move again. Today, oil prices are making headlines, and it's all because of a key decision by OPEC+, the powerful alliance of oil-producing nations that has a major influence on global energy markets. This group of major oil producers just announced they'll only slightly increase oil production for November, despite calls from some countries to pump more. That small move, like barely turning up a faucet, immediately pushed oil prices up by about 1%, sending a clear signal to markets everywhere. Why does this matter? Because even minor changes in oil supply ripple through the global economy, affecting everything from gas prices to groceries, airline tickets, and even the cost of shipping goods. OPEC+ is trying to avoid a supply glut, which would send prices crashing and hurt oil-producing countries that rely on steady revenue. But they also don't want prices to soar and slow down the world economy, making life more expensive for everyone and risking a drop in demand. Their cautious approach signals a focus on stability, not dramatic swings, as they try to keep both producers and consumers in mind. For consumers, this means prices at the pump might edge up, but wild fluctuations are less likely, helping families and businesses plan ahead. OPEC+ is watching global trends closely, aiming for that sweet spot. Prices high enough for producers, but not so high they hurt everyone else or trigger a global slowdown. It's a delicate balancing act, and every decision they make is felt worldwide, from Wall Street to your local gas station. Understanding these moves helps explain the numbers you see at the gas station and in the news, and why oil prices are always worth watching. So, who is OPEC+? OPEC stands for the Organization of the Petroleum Exporting Countries. Think Saudi Arabia, Iraq, and Venezuela. These nations coordinate oil production to influence global prices. In recent years, OPEC joined forces with other big producers, most notably Russia, forming OPEC+. Together, they control a huge share of the world's oil supply. When OPEC+ cuts production, prices usually rise. When they boost output, prices tend to fall. Their decisions are closely watched by traders, economists, and governments worldwide. Even a small change in their output can move markets. OPEC+ aims to keep prices stable, but their actions ripple through inflation, corporate profits, and even international politics. They're the gatekeepers of global oil, and their choices shape the energy world. That's why every OPEC+ meeting is a major event for the global economy. Let's break down today's numbers. Oil prices jumped after OPEC+ announced only a minimal production increase. Brent crude, the global benchmark, rose nearly 1% to $66.08 a barrel. U.S. West Texas Intermediate climbed just over 1% to $62.39. In commodities trading, a 1% move is a big deal. Billions of dollars shift on news like this. The market had feared a flood of new oil, but OPEC+'s cautious move reassured investors. By adding just 137,000 barrels per day, OPEC+ signaled they want to keep supply tight. This decision flipped market sentiment from bearish to bullish almost instantly. Traders now expect supply to remain snug, at least for the near future. It's a classic case of expectations driving prices. What matters isn't just today's supply, but what people believe will happen next. The market is betting on continued tightness, and that's fueling the price rise. Every OPEC+ move is a signal, and today's was clear: no flood of oil is coming. That's why prices are up. Oil investors are always balancing two fears: too much oil or too little. The oil market is a constant balancing act, where every shift in supply or demand can trigger a wave of anxiety or optimism. A supply glut, when production outpaces demand, sends prices tumbling and hurts oil producers. When storage tanks fill up and barrels pile high, companies face shrinking profits and even risk shutting down wells. On the flip side, a shortage can make prices spike, driving up costs for consumers and businesses. High prices at the pump and soaring energy bills can ripple through the entire economy, squeezing household budgets and raising costs for manufacturers. OPEC+'s latest move was designed to prevent a glut, reassuring investors who worried about falling prices. By coordinating production cuts, they aim to keep the market in balance and avoid a repeat of past price collapses. But the fear of a shortage never fully disappears. Even as OPEC+ acts, uncertainty lingers in the background, keeping traders on edge. Some traders are betting prices will rise further if supply stays tight. They watch for any sign of disruption, whether it's geopolitical tension or unexpected demand. This constant tug-of-war between bullish and bearish sentiment creates daily price swings. The market reacts quickly to news, rumors, and even weather forecasts. Every OPEC Plus statement and economic report is scrutinized for clues. Investors pore over data, searching for hints about future supply and demand. Will global growth slow and reduce demand? Economic slowdowns can mean less oil is needed, putting downward pressure on prices. Or will supply disruptions tighten the market? Events like pipeline outages or shipping delays can quickly send prices higher. Right now, OPEC Plus is signaling they'd rather risk higher prices than see a market flooded with cheap oil. Their strategy is to keep supply just tight enough to support prices. That gives prices a floor, at least for now. It reassures producers and investors that a sudden collapse is less likely. The market's mood can shift quickly, but today, the focus is on stability. Everyone is hoping for a period of calm after months of wild swings. Investors are watching for any sign that could tip the balance. A single headline or policy change can spark a new round of volatility. It's a high-stakes game, and every move matters. The decisions made today will shape the market for months to come. The result, ongoing volatility, but less risk of a sudden crash. For now, investors remain alert, knowing that in the oil market, certainty is always just out of reach. Behind the numbers, oil is a physical commodity, barrels pumped, shipped, and refined worldwide. The real test of market tightness is in inventories. Are storage tanks filling up or emptying out? When inventories fall, it means demand is outpacing supply, bullish for prices. OPEC Plus' small production increase is designed to keep inventories from swelling. As long as stockpiles stay steady or drop, investors will bet on higher prices. The physical market and financial market are tightly linked. If refineries scramble for barrels, prices rise. If oil sits unsold, prices fall. Right now, physical data supports the bulls. No sign of a glut yet. OPEC Plus is managing supply to keep the market snug. That's why the price rally has legs. Russia is a crucial player in OPEC Plus. As one of the world's top oil producers, Russia's actions have global impact. Geopolitical tensions have led to efforts to limit Russian oil exports, creating uncertainty. Traders worry that any disruption in Russian supply could send prices soaring. Yet, despite sanctions, Russian oil shipments remain strong, near a 16-month high. This steady flow eases fears of a major supply shock and caps price spikes. Russia's dual role, potential disruptor and steady supplier, keeps the market guessing. Bulls see risk in possible future disruptions. Bears point to current steady exports. The market constantly weighs headlines against real shipping data. Russia's position adds complexity to every OPEC Plus decision. It's a geopolitical chess match with billions at stake. The U.S. is now the world's largest oil producer, thanks to the shale revolution. Over the past decade, new drilling technologies like hydraulic fracturing and horizontal drilling have unlocked vast reserves, transforming the American energy landscape. Unlike OPEC Plus, U.S. production is driven by thousands of independent companies responding to market prices. These companies are nimble, able to quickly adjust their output based on changing economic conditions and global demand. When prices rise, American producers ramp up drilling, adding more supply. This flexibility gives the U.S. a unique advantage in the global oil market, allowing it to respond rapidly to price signals. The U.S. Energy Information Administration just raised its forecast for record U.S. output this year. Analysts are watching closely as production numbers continue to climb, setting new benchmarks. This surge in American oil helps offset OPEC Plus supply limits and keeps prices in check. U.S. exports are reaching more countries than ever, reshaping global trade flows. The result is a tug-of-war. OPEC Plus tries to manage prices, while U.S. producers respond quickly to profit opportunities. This dynamic creates a constant push and pull in the market. If U.S. output grows faster than expected, it could undermine OPEC Plus's efforts and trigger a glut. Oversupply can send prices tumbling, impacting producers worldwide. That's why today's price gains are modest. Markets know more U.S. oil is coming. Investors and traders are cautious, anticipating future supply increases. U.S. production acts as a buffer, reducing reliance on OPEC Plus and adding competition. This competition helps stabilize prices and ensures a more resilient global energy system. For consumers, this means less risk of extreme price spikes. stable oil prices translate to more predictable costs at the pump and for businesses. The American oil patch is a swing producer, balancing the market. Its ability to quickly increase or decrease output helps smooth out global supply shocks. Its record output is a key part of today's energy story. The U.S. is now a central player, influencing prices and energy security worldwide. The U.S. keeps OPEC Plus in check, and that's good for global stability. As American oil continues to flow, the world can count on a more balanced and secure energy future. In oil trading, data is king. Weekly U.S. inventory reports are crucial. They show how much oil and fuel is in storage. The American Petroleum Institute gives an early look. The Energy Information Administration provides the official numbers. This week, API reported a rise in crude stocks, a bearish sign, but gasoline and diesel inventories fell, showing strong demand. Traders analyze every detail. Is crude building up because demand is weak, or are refineries just processing more? The EIA report will confirm or challenge these signals. If crude stocks keep rising, prices could fall. If they drop, bulls get a boost. These reports drive short-term price moves and shape market sentiment. Every week, the market holds its breath for the latest numbers. It's a ritual that keeps oil prices moving. What's next? OPEC Plus's cautious approach sets the tone for now, price stability over market share. They're willing to let others, like the U.S., grab some market share to avoid a price collapse. The market's focus will shift to global economic growth, U.S. production, and Russian exports. Any surprise from these players could quickly change the outlook. The next OPEC Plus meeting is the big checkpoint. Will they stay cautious or open the taps? Their decision will hinge on data inventories, demand, and economic health. The oil market is a constant balancing act between managed supply and market-driven output. For consumers, expect continued volatility, but not a dramatic price shock. Today's 1% move is just one chapter in a much bigger story. The world will keep watching for the next twist.